So today we are starting on reconstruction and reorganization. So reconstruction and reorganization, nothing very serious. When a company is facing financial distress, they have so many options. Option one is to close down. And option two, to continue. And to continue, you can check ways on how to reorganize your operations. You can decide to negotiate with shareholders to reduce. Maybe our shares are having a par value of 20 and we feel they are quite expensive. We can negotiate to drop them maybe shillings what? 5, which is quite cheaper, so that many people can buy the shares. We get money, we proceed. Or we negotiate even with the creditors to prolong the credit period or even to waive some of the debts. So in this topic, we are going to check scenario whereby we are facing financial challenges and the entity is seeking possible ways on how to retain the operations. So how do you reorganize everything, negotiate with the directors, shareholders, creditors, to see possible ways of surviving? So before we go into deep, let's write this. We have to write something small regardless. So right there and say, reconstruction and reorganization. Reconstruction and reorganization refers to the rearrangement of capital structure. Refers to the rearrangement of capital structure of an entity. Rearrangement of capital structure of an entity. Including reduction in the claims of the shareholders, and the creditors. Full stop. Another hyphen. You say, such rearrangement of capital structure, such rearrangement of capital structure becomes necessary. Such rearrangement of capital structure becomes necessary where a company has been operating at a loss. Becomes necessary where a company has been trading at a loss over a long period of time. Or the company is in financial distress. Financial distress. Full stop. Down there, types of reconstruction. One, internal reconstruction. Internal reconstruction. And two, we have external reconstruction. We have internal reconstruction and external reconstruction. Let's start with number one, internal reconstruction. Internal reconstruction. Internal reconstruction. So those people are supposed to bring to examine EPS. In the worst case scenario, they don't examine EPS, they will bring internal reconstruction. That's it. If they fail to bring earnings per share, they will bring internal. So number one, let's start with internal reconstruction. Is a form of rearrangement. Is a form of rearrangement. Thomas, it's when you're waking up. You're not officially will join us and all that. Is a form of rearrangement where the capital structure of the company, form of rearrangement where the capital structure of the company is reorganized internally. Is reorganized internally. Full stop. Internally means we negotiate ourselves. We don't involve outsiders. The outsiders we can involve the creditors, but not selling off the company. External reconstruction. External reconstruction. External reconstruction. External reconstruction is a form of reconstruction where a new company is formed. Is a form of reconstruction. Form of reconstruction where a new company is formed to take over the business operations. To take over the business operations of an existing entity. Of an existing entity. Full stop. Another effect under external, the selling company is wound up. The liquidated is wound up. The existing company, the existing what they're selling. The selling company is wound up after selling its business activities. After selling its business activities to the new formation. Its business activities to the new formation. The new formation. Full stop. So I want us first to concentrate with the internal. Then once we are done with the internal is when we'll go to external. So maybe just to separate the two, internal, we reorganize ourselves internally without selling off our business operations. Where we cannot manage to reorganize internally and we have to sell our company, then we say we have undergone external what? So write down there, further aspects of internal reconstruction. So we want to check internal into details. Further aspects of internal reconstruction. Further aspects of internal reconstruction. Further aspects of internal reconstruction. Number one, it is, so those are the features. You can be asked the features of internal reconstruction. One, it is carried out without liquidating the existing company. It is carried out without liquidating carried out without liquidating the existing company. Without liquidating the existing company. Number 2, the company maintains stock retains. The company maintains stock retains its legal identity. The company maintains stock retains its legal identity. Number 3, the process of internal reconstruction. The process of internal reconstruction. The process of internal reconstruction must be authorized through a court order. Because it involves capital alteration. So lazima upate court consent. Lakini watu wanangi kotini, unaweza tu hapa kwa lawyer, alafu anakupea affidavit, ndio? Mkikunywa chai unasema I swear. Number 4, it involves alteration of share capital. It involves alteration of share capital. It involves alteration of share capital, comma, variation of shareholders' rights, variation of shareholders' rights, comma, reduction of par value of share capital, reduction of par value of share capital, and surrender of shares, Full stop. Next, number 5. Capital reduction normally takes place when the entity has been reporting capital reduction normally takes place when the entity has been reporting successive trading losses. Capital reduction normally takes place when the entity has been reporting successive trading losses and the share capital of the company no longer represents the company's net assets. No longer represents the company's net assets. You know, what is net assets? Assets minus liabilities. So if you take your assets minus liabilities, it's not giving you the value of capital, then there is a serious problem. NB down there, the appointed receiver, or maybe I never mentioned, internal reconstruction is done by a receiver. Which company? Is there a company right now under receivership in Kenya? Is there any company currently under receivership? National Bank. National Bank is under receivership. Well, okay. So they are undergoing internal reconstruction. That is what you need to know. So the appointed receiver maintains a special account, maintains a special account known as capital reduction account. Please, capital reduction, uandike serious. It is the main account here. Maintains a special account known as capital reduction account. Known as capital reduction account. Known as capital reduction account. To effect all the transactions, during an internal reconstruction. To effect the transactions during internal reconstruction. Shallow. I don't worry, wewe utatumiwa na formats. Gulf Bank naambiwa iko under receivership. Imperial ARM Cement. So those ones I'm told they are under receivership. So now what happens? By the mukishika hii it's easy. It's all about playing with double entry. The appointed receiver, when you appoint receiver, the receiver should oversee. Once the company comes back to the path of profitability, you hand over to the management. Lakini kuna receiver anaweza kuja kureceive akiweka kwa mfuko, sio? So they are required for accountability to come up with an account known as capital reduction. Anything they do, they are adjusting the capital what? Reduction. So when we agree we are reducing the power value of our shares, you effect it here. We negotiate with the creditors, you effect it here. So it's all about double entry. When you cancel those shares, what do you do to the share capital account and how do you adjust it to this account? That one you can only understand with illustration. So get out the papers. Get out our papers. Get out our papers. Receiver is appointed by court, not by individuals. Lakini uchumi walifanya reconstruction wakafika hapo. Receiver alireceive. Hapo walienda receivership kweli. Hao waliamua tu. Hata walienda external kweli. 2015, let's start with the 2015. Which team is starting the World Cup today? Na kuna siku World Cup inaweza kuja Kenya? Or we are far from that? November 2015. So in World Cup niliona una support Argentina. Argentina. So let's check November 2015. Nani amepata? Sijui. 2B, page 122. Check page 122. Receivership. So hizo maswali za reconstruction, ukisoma tu kwa mtihani you can be able to know. You know you undergo reconstruction when you have been facing financial what? Challenges. So you'll get their names starting with the Tabu Limited, Matatizo. Nakwanga Tabu, Matatizo, Shida Limited. Yes, those are their names actually. So ukiona tu hivi ujue hiyo reconstruction. So November 2015, question 2B. Yes, page 122. Adan, huzuni ni ya nini? What is the difference? Someone is asking, Samuel, What is the difference between receivership and company administration? Receivership and company administration. No, you know that when the receiver has been appointed, he also administers on behalf until the company stabilizes, then they give back. So they are more or less the same, but administration cannot be that very formal through the legal process. But receivership must be through the legal process. Tabu Limited is a private company. Tabu Limited is a private company. 3/4 of the issued share capital of the company are held by the directors and members of their immediate family. The company's draft statement of financial position as at 31st December 2014 was as follows. So non-current assets, intangible assets, there was development cost, goodwill. Tangible assets, we have buildings, plant and machinery. Current assets, inventory and receivable. Current liabilities, payables, bank loans and overdrafts. Ordinary share capital, share premium. Accumulated losses is a negative retained earnings. So in some questions, they will not say accumulated losses. They will tell you retained earnings, but in brackets. So a bracket, retained earnings is accumulated losses. And those accumulated losses must be written off during reconstruction in the capital reduction what? Account. Lazima uzi cancel. Then bank loans and overdraft consist of 10% loan of shillings 400 million, carrying a fixed charge on the company's building and an unsecured overdraft of shillings 287 million. So what? The demand for the company's product has fallen drastically in the recent years, owing to the importation of high quality and cheaper alternative products from Southeast Asia. Those things are not helping us. The development cost appearing in the statement of financial position relates to a new product that has been perfected to a marketable stage and for which there is believed to be a strong demand. These costs have been properly capitalized in accordance with the provision of IAS 38. Capitalization means you recognize them as assets. The company is in urgent need of capital to meet existing liabilities and the necessary new investment in plant and working capital. Complete waste of time. A scheme of reorganization has been drawn up for consideration by the shareholders and the creditors. Okay, so let's see. The term of the scheme are as follows. So, lakini creditors kitambo waweke box pale wakuja hapo. Ati we are suffering, let's talk. Let's propose something. Let this company not go down. So they had a talk. 1, the shares of shillings 10 are to be written down to shillings 2. So they feel the share capital is quite expensive. So they are reducing the par value from 10 to 2. The main aim is to make them quite affordable. Other investors can chip in. And subsequently, every 5 shares of shillings 2 are consolidated into one fully paid share of shillings 10 story. The existing shareholders are to subscribe for a rights issue of 2 new shillings 10 ordinary shares at par for every share held after the proposed reduction and consolidation. No problem. A major supplier, that's a creditor, agrees to exchange a debt of shillings 180 million included in the trade payables for 18 million ordinary shares of shillings 10 per value. So there is a creditor who has accepted, instead of being paid, let me take up share capital. Number 4, in full satisfaction of the shillings 687 million owing to the bank agrees to accept an immediate payment of shillings 87 million. So balance in the bank 600. And to consolidate the balance of 600 million into a loan carrying interest of 13% per annum, payable in 5 equal annual installments commencing 31st December 2016. The loan is to be secured by a fixed charge on the buildings and a floating charge on the company's remaining assets. The credit balance of the share premium account and the accumulated losses and goodwill, I think there is not okay there, are considered valueless and are to be written off. Of course, otherwise iposema goodwill and accumulated losses, you have to write them off. You cannot say you are suffering, you are under financial distress, and at the same time you are telling people we have serious goodwill. They don't match. So goodwill must always be written off when there is reconstruction. The assets listed below are to be restated to the following amounts. So restatement means now these are the correct values of the assets. So we'll adjust them to that. A group of dissatisfied shareholders plan to oppose the scheme because they feel they have borne an inordinate burden of reorganization where the bank has lost nothing. So there are some shareholders, after we have discussed all these proposals, wakaamua tukutane nyuma ya tent, hii kitu isipite. We are not for it. Bank has lost nothing. By the bank hakuna kitu wamelose because deni yao ilikuwa ngapi in that note 4? 687. Na waka agree nini? Walipo 87 immediately, then hiyo imebaki na interest ya 13%. Na hiyo ndio bank sasa, sio? So there are some shareholders wamesema hapana. Hii kitu lazima tu oppose. 8, the company has received a cash offer of 1120 million, no wonder, for its non-current assets and current assets. So there's someone who is willing to buy the company at 1120. 1120 ni pesa ngapi? 1 B. Yeah, this is 1.1 billion. So someone is willing to give them 1 billion. No wonder. Wanaona hii kitu ya kwenda mbali, tuchukue hii pesa mbio mbio tuachane na hii story. Okay, required. Revised. The revised statement of financial position of Tabu Limited as at 1st January 2015 after conclusion of the proposed scheme of reorganization. And 2, you give a report to the group of dissatisfied shareholders advising on whether they should accept or reject the scheme of reorganization. So you'll give them a report. Wakubali tufanye reorganization ama tukubali hiyo pesa yenye watu wanapewa. So I want us to start. So before we start, though it was not asked, this account called the capital reduction, almost all questions, I don't know why it is not there. Questions of internal reconstruction, it will always be there. So it is my wish we just do it for what? For fun, eh? No, it's always a very serious account in internal. So let's do it as a working, though we can do without it, but in the subsequent questions you will get it. So let's just have it here. Capital reduction account. It's a very common account in internal reconstruction. Capital reduction account. Capital reduction account. So among you here, are there people who can even oppose CASNET bringing exam after 2 weeks? So after 2 weeks. Exam is in 2 weeks. Can we have a group of dissatisfied?
Yes.
How many weeks? 4. Hata mkiongezwa 4 utatumia moja kutembea. Kiritia anasema hata wa reduce to 1 week. Wapunguze kuja next week. Mmalize mapema. Now be ready. I want us to start. It's all about double entry, by the way. So what we do, we go with the notes. Let's go with the notes. We go to the notes. So to the notes, we go with the notes pole pole. Note number 1, the shares of shillings 10. We check capital structure, the balance sheet. Shares were having a par value of 10. Kindly confirm.
Yes.
Sure. So the par value was 10. What has happened? So the shares of shillings 10 each are to be written down to 2 shillings per share. So the holders of those shares, how much are they losing per share? They are losing 8. So that reduction, what you do, you adjust in the share capital account, though I don't want share capital account, ordinary share capital, we all know equity is always done what? Credited. So when you are reducing equity, you debit equity account, you debit the share capital account, then you come and credit capital reduction, the corresponding double entry here. So ordinary share capital with the reduction, they are suffering. So you check how many shares did we have? The number of shares? It was 800,000 divided by 10. So we had 80. So you take 80,000, then 80 has been reduced by shillings. How much per share? 8. The par value was 10. The par value was 10, but they have agreed to reduce it to, not by 2 shillings. How much? 2. So each shareholder is losing how much per share? 8. So that reduction, you debit the capital account because capital is always credited. So to reduce capital, debit the capital account, credit the capital reduction. With how much? 640. So have there 640. Next. And subsequently, every 5 shares, no, that one has no problem. Consolidation is just doing the same thing. Go to number 2. The existing shareholders are to subscribe for a rights issue. Subscribe for a rights issue of 2 new shillings 10 ordinary shares at par for every share held after the proposed reduction and consolidation. That one comes later, after. So subscription will go even to the cash book. When they subscribe, they pay. So you debit the cash book, then you increase the number of shares. And that one will come after the proposed reduction. So it will not affect this account. So here, watch it, will just affect the cash book and the shares. Number 3, a major supplier agrees to exchange a debt of shillings 180 million included in trade payables for 18 million ordinary shares. So that one will not affect this. Because suppliers need creditors. Creditors in the account, creditors are on which side of the ledger? So they need credits. So when they agree to exchange, debit the payables, then increase the number of shares. Sure. So wanapewa shares. So reduce the payables, then increase the number of shares. It will not affect that account. Number 4. But number 4, I don't see it going to the capital reduction. In full satisfaction of the shillings 687 million owing to the bank agrees to accept an immediate payment of 87 million and to consolidate the balance of 600 into a loan carrying interest at the rate of 13% per annum. Payable in 5 equal annual installments commencing 31st December 2016. The loan is to be secured by a fixed charge on the building. So that one does not affect here. When we pay the loan, debit loan account, credit the cash book. Sure. So that one will not affect capital reduction at all. Go to number 5. The credit balance on the share premium account, accumulated losses, and goodwill are considered valueless and are supposed to be done what? Written off. Anything being written off, we must write off against this account. So share premium, check share premium. Share premium, being an equity, is on which side of the ledger? On the credit. So when you are writing off, you debit the premium account, then you credit which account? Capital reduction. So share premium, it was how much? Can you check it in the ledger? In the balance sheet up there? It is 50, yeah? So this is 50. That is 50. Then they want us also to write off what? Goodwill. Goodwill is an asset. Sure. Asset is always on which side of the ledger? Debit. So when you're writing off, you credit the goodwill, debit capital reduction. So I just want you to know, kila siku goodwill written off hapa. So goodwill, how much was the value of goodwill? 60. Then accumulated losses must always be written off. So bring it here, we'll explain the logic, but nataka tu mjue goodwill, accumulated losses, write them off here. So accumulated losses, but I'll tell you why it comes on that side. Accumulated losses is 232. You as accountants, in the P&L, profit and loss account, profit is normally credited or debited. Income, credited. See, an income is a credit, while losses and expenses are what? A debit. So accumulated losses will always appear on the debit of the P&L account. They're on the debit. So to write them off, credit P&L, then debit the capital reduction. But kwa mtihani hakuna time ya kufikiria hizi vitu mingi. Tukifanya maswali itastiki. When writing off intangible assets, accumulated losses, debit the capital reduction. And even accumulated preference dividends in arrears, we write them off. Though I've not seen them in this question, you write them off by debiting that account. Number 6, the assets listed below are to be restated to the following amounts. So it means the amounts in the balance sheet were lying to us. They were not the correct values. So what you do, you check, listen to that, you check whether it is a gain or a loss. If it is a gain, how do you adjust the gain on the asset? You debit the asset account. So come a revaluation gain, you debit the asset, then you credit capital reduction. If it's a loss you reduce the asset by crediting the asset, then you debit capital reduction. So let's check them one by one. The first one is plant and machinery. What was the book value of plant and machinery? 326. And the restated value? 5. A loss, eh? A loss of how much? 201. So what do we do? Thomas, what do we do to this? We credit this account.
It's a loss.
We debit because we will credit the asset account. Eh? So you just come here and say plant and machinery, the difference. You're set to 1.
Yes.
Then inventories. What was the book value of inventories? 426 to be adjusted to 210. Another loss. Eh? So you bring it here. Inventories. Inventories. How much is the loss?
216.
216. Then we have receivables. 500 book value. 531. Another loss. Of how much? 31. Then finally, we have buildings. Buildings book value was 270 to be restated to how much? 320. That's again. So debit building, credit this account. But the capital reduction gains comes on the credit side. All these things are gains. I can explain to you how they are gains. So buildings, how much? Yeah? 50,000. 50. So bring there 50. Number 7 ni wale watu walikuwa na disagree. So that one has no problem. Number 8 ni cash offer, question. So we are done with capital reduction. Normally, though not always, this account should balance automatically. Receiver akifanya kazi yake vizuri, amebalance assets vizuri and liabilities, this account should balance. So can you confirm for me if it is balancing? Just a minute. equal variation. So how much? 740, 740. On the extreme side, if you get balance in figures, balance as this side, this one is always called debit credit, capital reserve. Capital reserve, just in case, but most it should balance. Balance in figure. If it balances that side, if it balances this side, this is goodwill. But very rare will you find that account failing to balance, but just in case. So Hussein, so in real sense, in real sense, we are the receivers of Tabu Limited. So Hussein asema sisi ndio receiver wa Tabu. The way we are doing it, are we doing it as the receiver? Since we are assessing there is, yes, so we are the receiver. So yes, Hussein, we in real sense we are the receiver. We assume we are the receivers. So before we go to the revised balance sheet, there is an account which has changed. Ordinary share capital. It is always advisable to adjust that account. There has been some changes. So right for me there, ordinary share capital. It will always have some changes, so it is good to reconcile it again. Have it this way. So have that. So balance brought down, start from there. Of course, on the credit, what was the opening balance for ordinary share capital, which was there in the balance sheet? It was 800. So here we had 800. So I have 800 there. Then it was reduced by 600 and what? 40. So you debit the account, reduce. So you come here and say capital reduction, capital reduction. Capital reduction, it has been reduced by 640. Then there is something they say. I want you to read note 1, note 2, note 3. I think only those 3 will affect. So note 1, they said the shares of shillings 10 are to be written down to 2, which we have done. And subsequently, every 5 shares of shillings 2 each consolidated into 1 fully paid share of shillings 10. There is no adjustment we will do, but what they are saying is this. That but then after reducing how many shares after the reduction, you know, this one was leading up 80, so no 80, but now 80 has been reduced to shillings what? 2. Sure, which is equivalent to shillings 160. The other 800 minus 640. So it has been reduced to 2. So wanaona hivi that watu watawachekelea shares of shillings 2 sasa hiyo ni nini? So wanajifanya tu that now they want to do this. Subsequently, every 5 shares of shillings 2 to be consolidated into 1 fully paid share of shillings 10. So instead of having 80 at 2, instead of 80 at 2, let's have divide this by 5. 16. Let's have 16 at 10. So it's the same. It's the same thing. Neither to at least probably on mechanical sawa. So you cannot adjust that one in the account because at the end of the day, this minus this is the same. What they are communicating, any shares will come thereafter, must come with a power value of shillings what? 10 again to simplify it to. So go to note number 2. The existing shareholders are to subscribe for a rights what? Issue of 2 new shillings 10. So let's just say your 10. Of 2 new shillings 10 ordinary shares at par for every share held after the proposed reduction and consolidation. So when they subscribe, you increase the number of shares. So you come here and say cash book, you will debit the cash book. This is a rights issue. Rights issue. On what basis? They were subscribing for a rights issue of 2 new for every 1. So for a rights issue of 2 new shillings 10. You know that is, you get 2 for 2 new shillings 10 means 2 for every 1, but the one has a value of shillings what? 10. So 2 new shillings 10 after. So 2 new for every 1. But how many shares do we have as we talk? 16. So we reduced to 16. So right now we have 16, but 16 of shillings what? 10. So get 2 for every 1. 2 for every 1 times 16. Then you multiply with the par value, which is shillings 10. How much do you get? Unapata ngapi? 320. So bring here 320 through the rights issue. You'll remember to debit that in the cash book. Finally, note number 3. Check note 3. A major supplier agreed to exchange a debt of shillings 180 included in the trade payables for 18 million ordinary shares of shillings 10. So we gave the suppliers what? Shares. So increase the shares. Increase in shares is a credit. So ordinary shares. Ordinary shares. Sorry. What am I writing? Trade what? Trade payables. Trade payables, we are giving them how many shares? 18 million. But 18 million at a value of 10. So that is 180. So you increase the number of shares by creating that account. That is all. There is nothing affecting shares anymore. So just give me the balance carried down. It should be this side. Balance carried down. So that is what will go to our new balance sheets. So you are getting how much? 60. 660. Please, we can now prepare the revised balance sheet after the scheme. So right there, like after revision, should they still stick to the same name? Yes, because the company is not being liquidated, you still stick to the same name. So Tabu Limited, I think that jina hata ukitaka kampuni shwari. Hata ukienda kwa financials, wanaweka break. Ukienda watu wakupe loan na hiyo jina. So wanasema wait a minute. Who are you giving loan? Why? Wako na tabu. Revised statement. So revised is after the proposal. As at when? First, 20. Shillings were in thousands. Of that. Now, upper revision, hey, you did not even have to do all these things for you to score many marks. You can go straight. You go to the previous balance sheet. You copy, but now you make adjustments. Like for the assets, there are some which were restated. The ones restated, go for the restated figures. Now those are the new values of the assets. So we copy this one of theirs, but we make, where there was adjustment, we make. Where there was no adjustment, so we start from top. Non-current assets. Hapa kwa intangible assets. Intangible assets, we have development cost and goodwill. Goodwill was written off, so it is not there. So just pick development cost, and I don't want to separate them. Where I look at development cost. Development cost, just pick that value the way it is. 80 what? 85. Buildings. Buildings was restated. Sure. Yes, it was restated to what value? So you pick the restated values. It was restated to 320. So you post that one. Plant and machinery. Plant and machinery was also restated to what value? 125. There is no any other than current. Can you add the 3? Add the 3. Hmm? 530. Current assets. Current assets. Inventories. Inventories was restated to how much? To 10, first column. Receivables. Receivables was restated to how much? 500. Then what? Cash book came up. Yes, cash book came up. For cash book. Cash book. On the rights issue, when these people subscribed the rights issue, we got how much? 320. Yeah, through the rights issue, we got 320. So debit here 320. Kuna watu wanaitwa bank. Kuna story walileta. Walipwe. They were paid how much immediately? 87. So you subtract 87. You can indicate 320 was the rights issue, 87 is the bank loan, whichever it is. 233. Nothing else. Can you add the 3? Nine? 943. So total assets. So 1473. Equity, not capital. Equity and liabilities. Equity and liabilities. Rudi hapo ushikilie hiyo yao. Mimi nimeruka hiyo style yao walikuwa wamepanga. So ordinary share capital ordinary share capital. There's been alterations. So check the account we have reconciled. Check the account we have reconciled. Umepata balance current down about 660. Check again under equity. New yao unashikilia. Under equity, they have share premium was written off. Sure. Yes. Accumulated losses also written off. So under equity, nothing. Non-current liabilities. You remember the bank loan ilikuwa 687. Sure. Then they said they should be paid how much? 87. And the remaining 6 to remain as a loan at what interest? 13% bank loan. Bank loan. So the 687 minus 87. That is how much? 600. Current liabilities. Current liabilities. Wait, nani alienda wapi? Governor alienda wapi? Asisa kaja. Tuko na governor kwa hii class. Unaona wewe? Eh? Yes, alienda wapi? Eh? When your neighbor? Let's go to current liabilities. Trade payables. Payables. Payables, there's a part which was given shares. Eh? Yes, so you deduct, you reduce the value with the shares. So this is 393 minus what? Your shares 180. The shares they were given came to 180. This one here. So reduce what they should claim. Susan? Sawa. So how much is this? 213. Something else under current liabilities hakuna. Sio bank loan tumeligawa. Hiyo 687. So it is over. Can you add whether it is balanced? So total equity and liabilities. How much is this? 1473. Is that very hard?
No.
Better that one than EPS. Alright. So that is part A. Being allocated how many marks? 10. Eh? So 10 is enough. Alright, so part 2 of the question. Part 2, they are saying they want you to give a report. A report to who? A report to the group of dissatisfied shareholders, advising on whether they should accept or reject the scheme. So I want you to tell me. Nasima ajabu. Si watu unaishi karibu na wao wanajua wewe ni accountant. They can tell you to help them. Can you tell them whether to wafunge hii kampuni ama wa reorganize internally? Kuna wenye wanakataa, kuna pesa inakuja, tuchukue hii pesa ama tuache. Tell me, do we accept reconstruction tuendelee na kampuni ama tufunge tuchukue hiyo pesa? And you must justify. Si ati unasema tu. You have to justify your answer. Wanatupea pesa ngapi?
1.1.
Yes. So the question tuchukue hiyo pesa. Ngoja kwanza. Susan, do we have a class in the evening?
Please, no.
Imetoka wapi kwanza? Tumewahi kuwa nayo? Susan, huyo umetoa wapi? Mimi sijaiona tukikuwa na hiyo class. Susan, I don't know hiyo umetoa wapi. Haya, so tell me, do we accept to reorganize, or when we don't reorganize we sell it off and we get this money tomorrow? Kesho tuko na hiyo 1 billion hapa tukae. No, Susan, I never said we have a class. Maybe we'll scare vibaya. Maybe, I don't know. Maybe we'll ukusikia vizuri. We don't have. Tuko sawa. You are saying we reorganize. Why do you think we should reorganize? These assets are more. Hiyo ndio unaangalia. Na ukiangalia net assets. Net assets. You should check net assets. Net assets is this minus the liabilities. Liabilities is this and this. Yes. Eh? Na shares pia iko inafaa ikompensetiwe. Now, wacha kwanza uone what is happening. If they decide they are not undergoing reconstruction, the first thing to be done, you have to pay liabilities. So, yes. And liabilities you will pay out of the cash you are being given. Si wananunua? So wakupea pesa ulipe liabilities. Hebu niangalie liabilities hapo kwa kitabu, hapo kwa balance sheet. So don't go to the reorganization. Check the balance sheet. What is the value of liabilities which we have? Liabilities total 1080. You are seeing 1080? Tupea pesa ngapi? 1120. Can you take 1120 minus 1080? 40 what? Sema 40 vizuri. 40 what? Umbaki na 40 million. Kwa hii 40 million, ujue hata hujalipa receiver. No, actually it doesn't say receiver, liquidator. Yes. You are selling off. When you are selling off, now we don't talk over receiver. We talk over liquidator. You have not even paid a liquidator. So to know whether to sell or to retain, check how much you are receiving less the liabilities. Then what you get, quickly compare with the value of capital. Unakuja kwa equity. If it is more than, is far much than the equity, then subtract the liquidator's fee. Then again you compare. If this one is still higher, don't sell off that company. Let's write it in a formal way. Reports to dissatisfied shareholders. Report to dissatisfied shareholders. Kuandikia report to the dissatisfied shareholders. So unawaita unawaambia wacha niwaelezee hii maneno. But nataka kuanzia safari bali for understanding purposes. So you start by saying the ordinary shareholders owns the equity of the company. The ordinary shareholders owns the equity of the company. Owns the equity of the company. Owns the equity of the company. And therefore benefits from any increase. And therefore benefits from any increase in the value of ordinary shares. Any increase in the value of ordinary shares. Full stop. Another paragraph. If the scheme is rejected, comma, the company will have to be liquidated. The company will have to be liquidated. The company will have to be liquidated The company will have to be liquidated. Will have to be liquidated, in which case the liabilities will have to be settled. Have to be settled. In which case the liabilities will have to be settled. Will have to be settled out of the cash offer. Be settled out of the cash offer. Out of the cash offer. Leaving the company with shillings, when you have shillings, 40. Yes, leaving the company with shillings 40 million. Leaving the company with shillings 40 million, open bracket, 1120 minus what? 1080, yes. 1120 minus 1080, close the bracket. Which is less than the value of ordinary share capital. Which is less than the value of ordinary share capital available, value of share capital available to the members, now, yes, available to the members after the reconstruction. After the reconstruction. After the reconstruction. Full stop. Another paragraph. During the reconstruction, accumulated losses are eliminated. During reconstruction, accumulated losses are eliminated. Accumulated losses are eliminated, meaning that the entity will be able, to settle, not to settle, to pay. The word settle will not come out well. The entity will be able to pay dividends. Will be able to pay dividends as soon as profits are realized. As soon as profits are done what? Realized. As soon as profits are realized. As soon as profits are realized. Full stop. When do we pay dividends? When the company has reported what? Profits. So what is making them not to report profits is the balance brought down for losses. But now you see during reconstruction, losses must be done what? Written off. We agree to write them off. So it means starting from today, we are starting at zero. The amount of we return earnings. So any moment we realize profit, we pay what? Dividends. So when you want to argue, what you do, you check how much is the cash offer minus the net assets, the liabilities. So once you subtract liabilities, compare with the net assets, which is the equity. The net assets will be this minus this and this, you can do up. So you check with the equity. If it is much higher, you check liquidator's fee. Una subtract. If it is still higher, then user. But if it falls below this, 660, yes. When it is less than 660, then let's reconstruct that company. November 2020. November 2020. November 2020. Question. 4B. Page. What were page? So tuchukue 2 minutes break, tupige story. Set naenda. Tupige story. Did you watch the video I shared with you ile ya Casnem? You need to. In the video, the somewhere they are saying it applies to all of you. Hakuna mtu sahi yako kwa all syllabus. You need to attend the workshops. But the workshops relates to people who are not working. They say something like that. So if you are working, then you need to present your proof of where you are working, so that they can justify that you don't need to go for the workshops. So after exam, engage CASNEP. Ndio usiende kufanya, because I know some of you here who are doing specialization right now and they are going to pass. Usiende kwa data, your data analytics, then ukimaliza ndio unasikia kuna kitu ilibaki ya workshop. So uende wakumalizie, then ikuwe sawa. Break is over. Which page? 46. 46, 47 thereabout. Lakini kuna ya Boniface ni 43. So usipopata 47, 46, go to 43. Hadi 48. Kwani ni refu aje? Yangu 46 iko kweli. Hii inajiita dynamics. At least walijaribu hiyo jina. Lakini dynamics means sio data analytics ni compulsory. Hiyo data hakuna mtu hata wacha tuone mtihani utakuwa. I think hii first note wote wanaweza pita, sio? Kama walimu wa bibi wanafunza. Hakuna wanaleta 3 days to exam. So kuna siku walifanya hivyo. Students wakafikiria ni late. Hata wao. You know, data analytics imeletwa sasa ni CBC. Ni CBC ya CASNEP. Hiyo ndio ilikuwa mzuri. Under the CBC curriculum. So all about data analytics. Aya. Let's read the question. Well, kuna hiyo part A, though is not related with what we are doing. If you can remember them, the better. Distinguish between the two types of joint arrangements under IFRS 11 joint arrangement. Unazikumbuka? Which one and which one? Vertical. Joint arrangement kuna vertical. Two types of joint arrangements. Kuna vertical. The joint venture is one of them. Yes. And joint operations. So the joint operations and joint ventures. Vertical imetoka. So najua mtu anasema kwa roho naenda kukalia hiyo sasa. Ende ukalie. Aya, Dynamics Limited has been reporting losses for the past few years. Susan, what are you saying? At the CBC is a form of joint. What that does mean? Dynamics Limited has been reporting losses for the past few years. The creditors and shareholders have come up with a capital reorganization plan aimed at putting the company back on the path of profitability. Hapo ndio unapata creditor mmoja anajifanya mwenye yeye supply so many tons of what. The following is the summarized statement of financial position of the company as of 30th June 2019. So that is the balance sheet. That is before reconstruction. Hapo chini The court approved the scheme of reorganization and it was to take effect on 1st July 2019. Details of the approval of the approved scheme were as follows. Well, your story ko hapo. Ukisoma by the time uko number 8, will you remember number 2? Complete waste of time. Check required. What is required? The capital reduction account record the scheme of capital reorganization. How many marks? 8. Because tumefanya hapa for fun. So now what I will propose, let's come up with that account. Tukisoma, we put, instead of reading all those things, then wengine wataanza kulala. Susan, what is the issue? Watoto? Ati watoto wamecheka ati mama ako CBC. Wabini CBC ya watu serious. So have their capital reduction account. Capital reduction. Hii mnasoma ni ya kutengeneza syllabus. Curriculum ya CBC, si ya watoto. So capital reduction account. Capital reduction. Na sasa tumia earphones. You can make me to be exposed to unnecessary what? Capital reduction account. Leo mna story tunakapiga hapa. Ndio tumepelekwa kwa polisi. And for your information, I don't know about leo nitaweza mapema. I just wanted to do 2 questions in time. And this is the second one. So shillings are in thousands. External, they are wrong. So I want us to read pole too. Slowly. Then we adjust. We adjust for dynamics. We start. Yes. So let's start. Shillings are in millions, being informed. Shillings are in millions. Those who have copied. Shillings are in millions. So number 1, let's start with number 1. Number 1, what are they saying? Tangible assets comprise fuel, property, and plant, valued at how much? 3720 and 320 respectively. So respectively means fuel property is 27 and plant is 320. While the intangible assets comprise patents and goodwill, valued at 976 and 896 respectively. Patents and goodwill are to be written off. Hakuna kufikiria, we write them off first, is when we move. So we write off by debiting. So now we understand. Yes, so debit here. Then imeanza patents, no? So patents, how much? Patents is the one which is
480.
480. Goodwill. Goodwill is how much?
74.
Where? Don't confuse elders. Patents is how much? 9? Then goodwill? 896. Correct. Sawa. It is okay. Online wako standby. Alright, let's continue reading. So hizo mbili umepata uko na tea, see ati for free. They will be marked. They will reduce the gap between you and this part.
So that's better.
See, you want to break, so we have to comply. We proceed. An amount of 480 million is to be written off inventory. You know what they are saying? Inventory is to be reduced. Ile tulikuwa tunafanya restatement. So it is supposed to be reduced by that amount. So it means credit the stock to reduce. Sure. Debit this one here. So just write inventory. Inventory, I know it is being reduced. So inventory is to be reduced by how much? 480. Back up. Back up for 80. Proceed. And 374.4 million is to be provided for bad debts. Bad debts will do what to receivables? So it will reduce receivables. So credit receivables with that amount, debit this one here. Is a reduction. So receivables to be reduced by 374.4. 374.4. Correct? The remaining freehold property is to be revalued at 2480. Hapo kuna shida. The remaining means kuna imeuzwa. Labda iko huko mbele. So freehold we hold. You'll remind me we come back. Because I just hear anything touching. They have just said remaining. So maybe kuna sell hapo mbele. So we can hold. The investment was sold at the prevailing market value. Can you check for me investment, please? Check for me investment. Investment, market value is 896. And the book value? 352. We gained, we lost on sale. We gained how much? So the investment was sold at prevailing market value. So you check whether we gained or we lost.
From what? From the 352.
What is the book value?
392.
Book value?
352.
352. And market value?
896.
So you have gained, you have lost. So you have gained. The market value 896 is higher than the book value. So to again,
Yes.
so the gain will be adjusted here. So the gain on disposal, you of course, that is the cash flow. You bring it here. So gain on sale, investment, that is 896 minus 352. You have said how much? 544. 544. Correct? Story continues. Number 2. Do I think number 8?
Yes.
Leo.
6%.
The 6% preference dividends are 4 years in what? Arrears, of which 3/4 are to be waived. And ordinary shares are to be allocated at par for the balance. So hiyo nilikuwa nimewaguzia tukifanya ile, but it was not there. Now, preference, listen to me. Preference dividends in arrears is treated more or less like the accumulated what? Losses. You know, those are what we never paid in the previous years. So the rule is, first of all, you assume you are writing them off. Then, if they are compensated, I will cancel. So preference dividends in arrears is treated as accumulated what? Losses. So first of all, you write them off because these are shareholders. Then if they are compensated, fine. If they are not compensated, so that is always the rule here. Preference div in arrears. Bring in full, the full amount. The one which will be compensated well and good. So preference dividends in arrears, they were being paid at what rate? 6%. What was the value of the preference shares in the balance sheet? Balance sheet? It is 7360. What is this? Hapana. 25. Hebu check well, ndio tusifanye makosa. We should be 128 times 20, so no. Hebu confirm. I think the 7360 is the total. Yes. 2560.
Yes.
So 6% of 2560. But for how many years in arrears? 4 years. So times 4 years. They were 4 years in arrears. Sorry? 614. 614.4. Then were they compensated for their arrears? If not compensated, we leave them there as accumulated losses, not forward. But what did they say? 3/4 are to be done what? Waived. 3/4 are to be waived. To be waived means so it's again to the company. So if they waive, cancel it here. So you say waived preference if in what? In arrears. 614.4 times 3/4 times 3/4. Was 60.8. What is happening to the balance? The balance will be given ordinary shares. So to increase ordinary shares baadaye. Let's go to number 3. Your safari bado ni refu. Number 3, the 6% preference shares are to be written down to 15 shillings and existing ordinary kwanza tumazana na preference. Preference are to be written down to 15. What was the par value initially? Go to the balance sheet. It was 20. Written down to 15. So they are losing only 5. So what do we do here? So we debit. Huh? No, we credit because we are going to debit the preference share capital to reduce, then credit this account. So preference dividends, they were how many? They were 128. We are writing down by 5. I hope you have understood. See, preference share capital, since share capital the credit. So instead of the credit, when we are writing down, we are reducing by 5. So we debit this account, then we have just another account. So we were having 128 preference, then we are reducing by 5. So you credit that. How much? 640. So give us here 640. Very good. Tunasonga. In the same note, and the existing ordinary shareholders, 2 shillings what? Where? What was the par value of ordinary? We check ordinary. 20. Imagine par value at 20. Wamepunguza up to 4, meaning they're losing how much? 16. You know. How would I say God will work ways? How many ordinary were there? Huh? 240. 240 times 16. I don't trust those things. Do you trust these things? You kwanza kupunguza vitu. Ama in company nasikia let's take pay cut, 30% pay cut. Na wewe ndio unalini kuambia watu let's do that, God will. Hakuna. You rather just stop. You stop. Na uanze kufanya nini? Will you stop, then you start applying? Ziwa utapata pesa hata ya kuapply. What do you say? You start applying when you are there. How much is this? 3840. Next. Number, the same note. All the ordinary shares are to be consolidated into shares of shillings 20 each. The rate of dividends on preference shares to be increased to 10. That is not an issue to us. No, new consolidation, I say, it's the same number of shares. Number 4, there are capital commitments. Capital commitments. What's the capital commitment? Intention to incur on capital expenditure. Sure. Yes. There are capital commitment amounting to 2,400 million, which have to be done what? Cancel. So we got to make a contract nataka to incur, maybe to come up with a project, but now because to kuna shida ya pesa, what has happened? We want to cancel that contract. On payment of 3.3% of the contract price as what? A penalty. So there was a provision in the contract. If you cancel the contract, you pay us. What percentage? 3/3% of the what? The contract value. So when you pay, credit the cash book. Credit the cash book, debit capital reduction. So cash book, penalty. Cash book with that penalty, 3.3% of the contract value. So you will credit the cash book, then debit this account. So what is 3/3% of 20? Adan is giving me 20. 80. Am I your 20 required it down? 80. So 80. Give us there. Kalenda yako inasema ngapi? 10,000. I don't think a percentage here. So it's when we are done with note number 4. We are trying to try. Number 5. The 6% debenture holders were to have their interest. Yes? Were to have their interest paid in cash. So that one is no problem. Debit the debentures, credit that interest account. Paid in cash and to take over part of the freehold property. Unakumbuka kuna mali walisema the remaining freehold property. So we come back again. The 6% debenture holders are people who gave us a loan, were to have their interest paid in cash. So credit cash book, debit the interest account. Hiyo iko sawa. And to take over part of the freehold property. Book value of the freehold property being taken is 640. But they are taking it at a value of how much? 768 million in part payment of their holdings. So hapo kwanza kuna kitu tunafaa kufanya. The book value of the freehold property is how much? 640. They are taking over at what value? 768. There is gain on transfer of that property. Sure. Give me that gain. Gain in idea for capital reduction. So gain on transfer. Gain on transfer. Transfer of property. Gain on transfer of property. 768 minus 640. How much? 128. When they transferred that property, they transferred it at a profit. Aya, sitoki hapo. Can you go back? Can you go back to note number 1? What was the value of the freehold property? Because kuna kitu alisema to the remaining. What was the value of the property? Freehold property, note 1, additional information number 1. Freehold property 2720. The value, the initial value 2720. Then they have transferred they have given out another one with a value of how much? The book value of the one they have given us was 640. So if you get for me the value of the remaining. So take 2720. Ruth, ni nini nakusumbua? Tangible assets comprise freehold property valued at 2720. Waka transfer 640. So get the difference. How much is remaining? 2080. So 2080 remaining, they have said it was revalued. So what remained, they revalued to how much? 2480. So revaluation gain loss. Gain. So that gain back up. So revaluation gain, because you debit the asset on remaining what? Property. So how do I get the remaining? 2720 minus 640. It has been revalued to how much? 2480 minus 2720 minus 640. So the value went up. The value went up. Yes, Purity, 2480 of the revalue. Yes, they revalued the remaining to 2480. Remaining is this one, which you told me 2080. So it went up by 400. Back up. So that is 400. Let's proceed. We are still in note 5. We have not exhausted note 5. We have not exhausted note 5. The 6% debenture holders are also to provide additional cash of 832 secured by a floating charge. Floating charge is on the current assets, mostly stock, on the company's assets at the interest rate of 12%. No problem. Wakileta loan, I'll debit that loan in the cash book, then I credit loan account. So that one has no problem. Number 6, the directors were to accept settlement of their loan as to 90% thereof by allotment of ordinary shares. So directors loan, 90% we will give them shares. Now ordinary share capital change sana. 90% ordinary shares at par, and as to 5% in what? Cash. No problem. The balance of 5% is to be waived. Waiver inakuja hapa. Waiver is benefit on our side. So waived directors loan, waived directors. This side records income, the benefits to the company. Directors loan. So go to the balance sheet, check directors loan, waive 5%. Directors loan was 640. So what is 5% of 640? 32. So 32. Very good. Note 6 is over. Let's go to note 7. The trade payables were to be paid shilling 0.4 in every shilling to maintain and obtain an extension of the credit period. No problem. Payables kama wanalipwa, credit cash book, debit payables. Has nothing to do with this. The bank that has sanctioned an overdraft limit of 40 million, the bank has sanctioned an overdraft limit of 40 million to provide working capital. No problem. In fact, that note is irrelevant. It will apply nowhere. You know, if someone has sanctioned an overdraft limit, what you take the books is where you have reached. We do overdraft limit up to 40. It means you can transact or negative up to what? Up to 40. So just go to the books, one year overdraft, kama sahi, the current liabilities, overdraft is 1248. Now that is what you use. You don't sanction umepewa, si overdraft umepewa limit. Hata wacha kufikiria overdraft, fuliza, wacha niwaweke hapo. Fuliza si kila mtu ako na limit yake. That is the limit you have been given. No, ya ngapi? Hadi 500 sawa. So kama umetumia 300, 300 ndio unaleta hapo. You don't capture the whole 5. Umepata logics? So hiyo note number 8 is irrelevant. It will not be used anywhere. So you use the extent you have in card. Umetumia. Kwisha, can you add whether it is balanced? It should balance by the way. Wewe ile story. Check whether it is in order. Whether it is balancing. Is that diffused?
Yes.
When there's something we have not captured, I'm coming to check. Without much. Kama kila mtu ako na yake, ati ngapi? 26? 4? 26, 24. On which accumulated losses, did we write them off?
No.
Check balance sheet under equity. Oh, Joyce. So under equity, those ones you write off whether at all or not. You copy? Accumulated losses 26 what? 24. So write them off very fast. Accumulated losses, how much? 26, 24. Having that there, it is okay.
Yes.
Yes, you're back. Write off whether told or not. We don't carry, you don't reconstruct again, then you remain with the losses. See, you have done 0. Yes, now a proposal has arrived that ukifika tu hivi accumulated losses. Hata goodwill lazima. You have to write off. You cannot tell people that you have goodwill and you are suffering. There is no goodwill. So it is balancing with what figure? 16?
6044.
604. Like that. How many marks? 8. So how will they mark the 8? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. Any 8 at 1. Utatoka bure?
No.
Thomas, najua zenye uko nayo. Accumulated losses, patents and goodwill, receivable. Whenever one that I ordered, there is nothing there which is serious. Concentrate. Now, required Roman 2. The statement of financial position of dynamics immediately after affecting the scheme of reorganization. I'm afraid tutasumbuka hapo. Ordinary has changed so many times, and even the cash book. Those two. Can we reconcile those two? Then we give presentation. Kindly. So let's do those ones as are working. Then we do presentation. Let me start with ordinary. So right there, ordinary share capital. Ordinary share capital as are working. Of course, you will start with the balance brought down. So go to the balance sheet, then pick the balance brought down. Adam, 16 marks divided by 2 million. So balance brought down was ordinary. Are you seeing 48? Yes. So this is 4800. Then capital reduction, we reduced the 48. So you debit. So capital reduction, we reduced by how much? What ordinary happened? 38, 40. Check capital reduction for ordinary, we reduced by 38, 40. So nataka tusaidiane. There are some notes which were touching on ordinary. I don't know big issue. Can you try to check for them then to vishughulikia? There are two. There are two notes touching on ordinary. Which one and which one? Adan tunasema marking scheme. Marking scheme gani? Hii kitu ifiki 16. Ama hizi entries zimefika 16. Adan hajafika 16, so hizi kwa 16 na hapo. 15 or 14? They're 14. So haijafika hapo. Haya. Where are we? Which notes are talking of ordinary? Note 2, kidogo pole pole. Note 2, 6%, 4 years in arrears to be waived, and ordinary shares to be allotted. Yes. So there was preference dividends in what? Arrears. So we gave them shares, preference div in arrears. How what will our shares? So arrears itself was 614.4. 0.4. Then 3/4 were waived. So meaning shares was what fraction? A quarter. Soma tu vizuri. Enda tu note tu usome. Kizungu mnajua. Soma tu hiyo kizungu ya note tu. Does it make sense? Thomas? Yeah. See, arrears to calculate over 614. 3/4 were waived. And the balance, the balance is a quarter of that. So what do you get? 153.6. Which other note? There is another one more note. Talking of ordinary shares. There were two. Walikuwa napewa shares. Hii ya kuconsolidate hakuna kitu. Hiyo tu ni maringo hapo. The shares will remain the same. Note number 6. Yeah, note 6. The directors were to accept allotment of loan as to 90% thereof by allotment of ordinary shares. So directors loan account. So their loan account, directors loan account was 600 and what? 40. This 640, 90% will be given shares. So you credit that account. Yeah? What? 576. There is no any other notes. Balance carried down. There is no note talking of shares. And if you suspect there is any, please bring it. We check out. So the balance there is what we'll take to the balance sheet. 1689. Kuna mtu anakusupport? Ada amekusupport hapo. Sawa. Can we reconcile cash book? Cash book also has a lot of stories. Let's reconcile our cash book. Then now we can do the balance sheet. Let's reconcile the cash book. Let's reconcile the cash book. So cash book, is there a balance brought down? No. Is there overdraft? Yes. So overdraft brought down on the credit. So balance brought down on the credit. How much? 12.48. The way we have done this, cash book dollars ziko mingi, there are so many. Can you check pole tu from number 1 ukiteremka chini? Anything we ukiona tu moja tu unaniambia, we check on it. Number 1. So check number 1. Oh, number 1, ile sale of investment. So when you sell investment, debit the cash book. So investment, what was the selling price? 896. That was the market value. It was sold at market value. So debit the cash book. Any other note which you can spot? Note number 6. What are 6? Pole. 6. Oh, ile director's loan. The 5% was cash. So credit, they were given cash. So director's loan, 5% of 640. You know ngapi? 32. Directors were the liquid. 5% was in cash. That is note number 6. 4. Check note 4. Adam is saying penalty. So note 4 and your penalty. That penalty. There, take to anything. Your penalty ilikuwa ngapi? 80. So ndio. Ile iko capital deduction. So credit there with 80. Any other which you can spot in relation to cash? Note number 5. James. Note 5. Baja kidogo. Yeah, note 5, I agree. The 6% debenture holders are also to provide additional what? Cash. Additional cash of 832 million secured by a floating charge on the company's assets at the interest rate of 12%. So 12% debentures. They have provided additional cash of how much? 832. Any other? 5 part ya kwanza. 5 part ya kwanza. The 6% debenture holders were to have their interest paid in cash. Debenture interest. Debenture interest. Can you check debenture interest under current liabilities? Under current liabilities, pick it there. Debenture interest is how much? 144. Any other which you can spot? Any other notes? Any other notes? Yeah. Which one? Which one are you spotting? Number 7. Let's go to number 7. Oh yeah, number 7, Monica. The trade payables were to be paid 0.4 in every shilling to maintain and obtain an extension of credit period. Na hivyo ndio wanakuanga suppliers. Ati mtuambie mko na shida kwa ile deni yetu mko nayo, simtulipe hata shilling 0.4 of the total debt. So payables, they will not listen to your stories. Yeah, 40%. It is 0.4 for every whatever. It's like just 40%. What was the total debt? To me, 0.4. What was the total debt? 16. What is 0.4 times 16? 640. Hizo vitu zimeisha. Give me the balance carried down. Inabaki overdraft ama cash, wewe uniambie ita balance wapi. Can you reconcile the account? From there to wapatie balance sheet. Tumalizane na wao. Not 6. Well, balance to kwanza, then nitaku explain here. Because rule number 1, I'm accurate. So we balance, alafu nitakuelezea. Inabaki overdraft ama cash. Balancing figure 416. But the people telling me 416 hawaniambii iko side gani? Thomas, accounting unaweza niambia hivi. Debit ama credit? Debit, so hiyo ni overdraft. Because outflow is more than the inflow, so that's an overdraft. 416. At in a balance on. So Ruth, you're saying note number 6. The directors were to accept settlement of their loan. Their loan was 640. Yeah. Their loan as to 90% off by shares, 5% in cash, the balance was waived. So what don't you understand? See, 5% moja ilikuwa ya 5% moja ilikuwa nini? Waived. So if the kanyaga capital reduction, 90% ikakuwa shares na 5% cash. So what is the problem? The 5% wali waive, so waiver inaingia capital reduction, ikabaki 95. Then the 5 cash, then 90 shares. Sawa. Mtu asaidie Lynette before I change the camera. Lynette is asking, where did you get the 1248? Lynette, the way I know you, ulitoka class. Kuna maswali najua unaulizanga. Hiyo ya 1248. That question, ulitoka ukaenda kuchukua chai, ukarudi ukapata 1248 imewekwa. Nani amewekwa online atu confirm the rules of online? How does it operate? Unatoka kidogo alafu unarudi unasema where did you get? Ndio. Ama ukipata watu wanasema thank you, wewe pia unaweka hapo chini thank you very much. Aya, sawa. So let's go to let's go to where? Balance sheet. So right there, dynamics. But CP is very far. Kama ni campus mungeletwa hapa Sunday, ungekuja? Mungetokelezea kweli. Hatuna sasa ona life kwenye life mkwetu. Hata kuna mtu amekulazimisha. Oh. You know, everybody there is less, including the teacher. So there's no problem. Unasikia venye Piria anasema kama ni campus angekuja hapa, angekuja login ndio aende biashara zake. Like nowadays, meetings imekuwa interesting. Yeah? Do people attend those online meetings fully? I attend so many nikiwa hapa class. Naacha huko ni tu. Nikipata watu wameandika hapo, thank you for nice presentation. It was very nice, eh? That's where life has taken us. Eh?
Do you agree?
I don't know how to unmute myself to talk. I can't talk. So tunaenda tena na hiyo balance sheet yao, but the internal ufai kuanguka, unashikilia hii yao. Ikileta kichwa kabisa, which I know it can, we copy hiyo. Kuna zingine utapata, but don't do that because you are from Alliance. Non-current assets. Non-current assets were tangible assets. Tangible assets were break into two. Yeah, freehold, na hiyo ingine ilikuwa plant. Then freehold tukue kin, freehold kuna yenye walipeana na yenye libaki wakarevalue. So you take the revalued amount. Sure. Yes. So freehold property. How much was the revalued amount? 24? 80. Then plant and whatever, plant and machinery, there was no change. Pick that value the way it is. Is how much? 320. Upon not one. There was no any other change. Intangible assets. Intangible assets, all of them were written off. So some intangible assets comprised goodwill and what? And patents. All of them were written off. Kusha. Add the two. Napata gapi? 2800. Current assets. Inventory was interfered with anywhere. Oh yeah, it was written down by or to or by. Patterns, an amount of oil is written down off inventory, so written down by that. So you subtract. So inventory 2720 minus 400 and what? 8. How much? 2240. Next, receivables. Receivables. Receivable, there was bad debts. So write off bad debts, 3104 minus bad debts, which was how much? 374.4. How much is that? 20? 6. Investments iliuzwa. Cash book we have reconciled, tumepata overdraft. Kwisha. Add the two. Hapo kama ungecopy direct 0. Wewe toka 0. Unapata 14? 4969.6. Total assets 7769.6. Equity and liabilities. So speed, to observe speed. Na root siku ya mtihani usigai kanyaga hapo na kalamu ya red.
Yes, of course.
Unaweza na hapo na red usituke una. So equity tusonge na hiyo yao. Ordinary shares, so ordinary share capital we adjusted. ordinary share capital, we adjusted to how much? 1689.6. Wow. Preference. Preference iko na issue. Check note number 3. Please check note 3. And I don't want to go to deep workings. I want us to solve it there. Note number 3, they said the 6% preference shares are to be written down to 15, and existing ordinary shareholders, that fine. All the ordinary shares to be consolidated to 20, no problem. The rate of dividends on preference shares is to be increased to 10. So here you tell me 10% instead of 6. 10% preference share capital. How many preference share capital were we having? Tulikuwa na ngapi? So 128. So 128, they wrote it down to what value? 15. They lost 5. They lost 5 per share. Sure. So you write it down to 15. So multiply by 15. 19? 20. There is nothing. Yes. Can you add? Thirty? 36? 6. Aya, tunasonga. Accumulated losses, whatever, we wrote it off. Non-current liabilities. There is 6% what? Ventures. Hao ndio watu walichukua freehold yetu. So punguza hiyo freehold walichukua. So kuna freehold walipewa. So punguza hiyo loan. Punguza hiyo loan. So first it is 24 minus. They took that freehold at what value? 768. The book value was 640, yes, but we agreed they take it over at 768. So we need to reduce that. You are saying to your person. How much? 1632. Then again, the venture owners again gave us money. But the person wanted to pay in form of a loan. 12 what? 12% debentures. And they gave us how much? 832. That is a loan. You bring it here. 12% debentures. Imagine hiyo ndio swali waliona walikata sana. Lakini sisi tunaelewa. 832. Current liabilities. Current liabilities. Current liabilities, current liabilities. Accounts payable. Payable ni mabaya. Accounts payable take 1600 times 0.6. Sure. So walisema walipwe 0.4. So balance ni 0.6. Ama usubtract ile ilikuwa ngapi? Ilikuwa 640. They were paid 0.4, so remaining 6. You get 960. Bank overdraft, you reconcile the cash book. You reconcile the cash book, and we got an overdraft of how much? 400 and what? 416. Debenture interest pay. Your debenture interest is illipo. Sindio? Yes, it was paid in the cash book. So ignore the debenture, it was paid. Accruals. Accruals, hakuna mtu ameongelelea. Oh, so hata ungepick, ungepata hiyo tip. Accruals ngapi? 320. Directors loan ililipwa yote. Sindio? Hiyo loan mara 90 shares, 5 waived, 5 cash. Kwisha. Can you check whether we are in agreement with our total assets? Check whether we are in agreement with the total assets. What's wrong with you? The world is agreement, huh? Agreement is 77. 59.6. Correct. I want us to agree. Time is not there. Internal way with practice there is obedient. If you can't understand anything in these two, hata tukifanya 200 of them, it will be the same. But kama unaweza elewa hii ili uelewe hata 30%, hata hiyo wataleta utafanya nini? Utaelewa sasa hiyo ingine 60%, which is very perfect for you. So I'll give you solution for this one. I'll make a 2021. I'll share today in the group. December 2021 for your own practice. Question 4. December 2021, question 4. Wait, I wanted to question 4. Now, I will take like 15 minutes on the maximum side. I want to introduce the theory part of external reconstruction so that when we meet next, maswali. Sindio? I'm going to your notes, muandike. But I think discussing is more important. I'm giving you 2 minutes. 2 minutes break. Let's break kidogo. We come and write these notes on external reconstruction as we discuss. Then we remain with that question. You can relax in, out. Oh, a proposal. Someone is proposing. I send, we discuss, then you write later. Is that another good idea? Huh? At it? When to discuss. You know, the early morning work on another class, FM coming. So I need to give them some time. So let me share. We discuss. Ubaya tu ni moja. There's a group of dissatisfied individuals. Tukikuja hapa next class, which notes are you talking about? When were they shared? So let me share these notes right now. But take a few minutes break. Then I'm sharing also on the screen.
And Mane was making it. Mane was making it possible. So you need to
How? Kwani wanakuintimidate? Kwani hapa ndio meeting point ya kudiscuss World Cup?
Kila mtu anatoa 1K.
Ya kwenda
Hawa wanasema Messi atashinda. Mimi nasema Messi atashinda.
kushinda ni golden what?
Kushinda ni nini? Wala Beckham. Nafikiri I think the same thing.
Messi
What is the part? Is there a part? Yes. Is there a part? Messi is getting France. Germany?
Come on. Of those countries, where yet again?
In man. So I'm counting.
Eh?
I'm counting.
So Felix amesema umtumie hizo pesa. Thomas. No, see counties. So online we're requesting I share on the screen. So just a minute, I share to them. So go to those notes we discussed. Please remember to write. Remember to write. You can print. So
Yes, sir.
About printing, you utasema yes. So the handwriting may be in your how, but provided we can see what we want. There are only those 2 pages. So external reconstruction, amalgamation, and what? Absorption. External reconstruction, amalgamation, and absorption. So external reconstruction, this is a process in which a company's affairs are wound up and a new company is formed to take over the assets and liabilities of existing company. So when a company is being formed, any question, once you see a company is being formed to take over the operations of an existing entity, then that is external what? Reconstruction. Amalgamation, on the other hand, is the process where 2 or more entities are liquidated to form a new company. So you kill this one, then they come to form one. That is amalgamation. Absorption is the process in which the operations of an existing entity is taken over by another existing entity voluntarily or through hostile what? Acquisition. Yes, so absorption, an existing takes over another one. Amalgamation, the 2 comes to form one. External reconstruction, one is liquidated, the other one is formed to take over. So the one being formed is being formed purely to take over the existing entity. NB, for accounting purposes, there is no distinction between external reconstruction, amalgamation, and absorption, meaning you account for them the same way. So in exam, you see them saying external reconstruction, amalgamation, absorption, just follow the same way. Can somebody open for me November 2016, question 3A? What does it say? Sharp, sharp. November 2016, 3A, in theory form. In theory form. That's good. But if huko 110 huko. Nafai huko 110. Page 108. Question 3A. So 108 3A. The distinctions between internal and external reconstruction. So they wanted the distinctions. Number 1, back to our handout. Back to our handout. Distinction number 1, the meaning. Meaning clear distinction. Internal, it refers to the method of corporate restructuring, where an existing entity is reorganized. Existing entity reorganizes its capital structure internally. While external is one in which the company undergoing reconstruction is done what? Liquidated, and its operations taken over by a new formation. Yes. Yes, Mumeshika.
Yes.
Internal is being restructured internally. External, a new one is formed to take over the operations of the existing. Formation. No new company is done what? Formed. The other one, a new company is formed. Capital reduction. It involves capital reduction and waiver of external what? Liabilities. The other side, no capital reduction. 4, court approval. Internal, court approval is mandatory. External, only members' resolution is required. Yes, you don't need court order. Transfer of assets and liabilities. No transfer takes place for internal. Assets and liabilities are transferred to the new formation. Fine. The main concern, tumeshuka hapo chini. The main concern during external reconstruction. No, kuna kitu hapo chini. Number 6. I think mtu aliongezea yake. Mtu anafanya, si ndio? So internal is being carried out by receiver. External is carried out by liquidator. Yes. The main concern during external reconstruction is on how to determine the purchase consideration, i.e. the amount that the new formation should pay to compensate the entity being taken over. How much do you pay? So down there, the purchase consideration is determined by using either of the following methods. Following methods. 1, we have net asset method, lump sum method, and net payment method. The one which is highly recommended is the net payment method, the last one. So net asset method, under this method, purchase consideration is considered to be the difference between the total value of the assets acquired and the liabilities to be taken over from the selling company. So just take the assets you have acquired minus the liabilities. Then the difference is the purchase what? Consideration. Lump sum. The purchase consideration is agreed upon by the parties without taking into consideration the values of assets and liabilities. Tunakuja tu naangalia, nasema hii kampuni yako 1 million. Nikupe ama ukatae. Si hata dawari iko hivyo. Si dawari kuna wenye wanatumia hii lump sum method na wengine wanatumia hiyo net assets. Kama hapa Kiambu unaweza tumia lump sum. Ati wende useme hapa msichana wacha tu niwape 50,000. Net asset method, you have to do valuation. Yes, amesoma, she's a graduate, CPAK, na ameshuka nywele. Mwenye hajasoma? Mwenye nao hajasoma? When you go there, unaambiwa these are matters of elders. Wewe kijana unataka kuleta shida kwa society.
My culture also pay for the children, for the child if she has a much.
Come on.
Yeah.
That if the lady has a child, you also pay for the child.
My culture.
Which is
You pay for that child to acquire.
in total.
Yeah, because that child is also an asset.
Yeah.
So it's the acquisition of assets. But in our place, we normally use the lump sum method. We just say, ng'ombe mbili sawa, kisha hiyo story inaisha. Kwa hiyo ni mbuzi. Kwa kina Said, waliniambia ni the lady decides. The lady is the one who decides the value of the dowry. So kama mzazi alimsumbua, anasema mnaenda mnaambiwa bora Mungu yuko Wewe tusonge mbele tumalize. Net payment method. The purchase consideration is considered to be the sum, to be the sum of all the compensations to the providers of capital. Who are the providers of capital? Ordinary shareholders, preference shareholders, and we have debenture holders. And debenture shareholders. We have ordinary shareholders, preference shareholders, and debenture holders. So in the question, the examiner will tell you how ordinary shareholders were compensated. You know, people are closing and the company is being liquidated. So how much did you give the ordinary shareholders, preference shareholders, and the debenture holders? So the sum of what you gave them and the compensation can be in shares, cash, or in any form. You sum up all this, then that one becomes the purchase what? Consideration. Down there, the compensation may be in form of cash, debentures, or shares. That one I've said. In case the purchasing company pays or incurs liquidation costs on behalf of the selling company, then such costs should be treated and recognized as part of the purchase consideration. So kama walipia like liquidators fees and everything, you add. NB, net payment method is highly preferred for determining purchase consideration. We will follow it. Process of external reconstruction. One, wanagonga biased in the question. Sometimes they don't tell you, wanataka tuwe ipange na hizo accounts. One, you close off the books of the old company, which includes, you'll come up with an account known as realization account, where you close all the assets and all the liabilities. So the system of realization here, when you compare with internal, is capital reduction. So capital reduction replaces realization replaces the capital what? Reduction account. All the asset liabilities you close to realization account. Then we have new companies account. You will come up with the purchasers account to show how they have compensated. Then we have sundry. We have what is called sundry members accounts. So sundry members accounts, they are the final accounts of settlement to show how the shareholders were compensated. Once you have closed those accounts, you give us what is called sundry. Sundry are the ordinary and preference. So when you show how the providers of capital, most of the ordinary and preference were settled, those accounts are called sundry members. Then you open the books of the new company, which includes one, journal entries to record the acquisition, then opening statement of financial position. Then there are so many questions there, but I will start with the last setting. Last setting, I think they brought external. Let me see what. I think there was external reconstruction last setting. Na kwa roho mtu anasema sio basi tuachane nayo. Unaweza shikwa na butua yako ni kama yako tu. Hata yako hakuna. Question 4. I'm told last setting question 4. Realization. Yeah. So right there, August 2022. August 2022, question 4. August 2022, question 4. August 2022, question number 4. Page 4. Hiyo inakuja. To be safe, we have to do it. So let's meet. That one we'll do next week. So those who we are meeting tomorrow evening class, we are continuing with our EPS. So yes, EPS. Then after EPS, in the individual classes, tutafanya insurance. Combined next week, reconstruction again. Then we are done. So thank you. Have a nice weekend.
Which one?